But bringing in Amit Jeswani, founder of Stallion Asset Management. He's joining us this morning. Amit, good morning to you. We're just about 2 weeks left, not even two, I think we're just about a few days left to go for the new year to begin. We're at record highs. Is this optimistic cheer likely to last a little bit longer?
Hi Devina, good morning. Thank you so much for having me on your show. Devina, we are very bad with predicting what will happen the next year. I'll just give you an example. By end of 2016, there was demonetization and GST was going to happen in the next 3-4 months. Everyone thought that probably the economy will be bad because of demonetization. What happened was that Nifty and all other indexes went up anywhere between 30 to 50% in 2017. By end of 2017, we all thought that now promoters cannot do chori. Now the right strategy would be to buy chore promoters. But what happened in 2018 was exactly the opposite, and all chore promoters went down anywhere between 40 to 80%. By end of 2018, if you see any TV channel, the debate was about will there be a recession in the US market. If you see this year, the US market, Dow Jones is up 24%, Nasdaq is up 34%. So at the start of the year, whatever we predict, I can with some conviction say, looking at previous data, we always go wrong. So I like 2020 will be a very interesting year, but very tough to predict what's going to happen. There are way too many things that can go right, wrong for the markets. If you see the Fed was declining, was reducing its balance sheet after from 2009 to 2015. It was consistently increasing its balance sheet. In 2015, that topped out at $4.5 trillion. The balance sheet was steadily declining till $3.7 trillion in August 2019. But in the last 3 months itself, surprisingly, Fed has bought $400 billion worth of, it expanded its balance sheet by $400 billion. And that's why you see a very strong global rally. It's very tough to predict what 2020 would look like.
No, it's not about predicting, and I didn't want you to predict levels for me, but just the fact that if someone has to take an investment decision as they step into 2020, what kind of themes does one look at, whether or not there is, in fact, enough headroom left to go, because these are uncharted territory, and therefore, what kind of strategy should one adopt with regards to cash allocation as well? Does one sit on cash? Does one fully deploy?
Devina, we are fully invested. The trends are, no investors should question the trend when it's in force. If you look at private financials, AMC, insurance, consumer technology, MNC pharma, the themes are set for this bull market. There are stocks which are not slowing down their growth. Of course, the growth rate, the hurdle growth rate now cannot be 25-30%. You have to be comfortable at 15-20%. But now there are many companies. See, when companies grow at 15% in a slow, bad period, once the growth comes back, these will be the companies that will grow faster at 25-odd%. So we are going through a very cyclical, very dirty slowdown. This is the longest and the most painful slowdown the economy is seen. But what will happen? There'll be a gradual cleanup. This is going to be the Swachh Bharat bull market, Devina. It is very clear, the trends are clear that markets will not, there are 4 kinds of risk: business risk, valuation risk, management risk, industry risk. This bull market, one thing is very clear: do not take on management risk. The leader of last bull market was about taking management risk. In this bull market, the management risk will not work. The markets will be narrow. The rally will be similar to what happened between 2009 to 2014. If you see that rally, even though the markets moved nowhere, you had markets chasing pharma, consumer kind of stocks, wherever markets saw growth. And that time also, if you see, go back and see, everyone was complaining markets were narrow for that 3-4 years, but market chases growth. So why would someone bet on a small cap if the growth rate is not even 15-20%? Typically, like people like us bet on small caps if we have more than 20%, because my large cap portfolios are growing at 20%. Why would I bet on small cap till the time I don't get at least a 30% kind of growth? So we need growth for price to go higher for small caps as well. Though I do believe to 2021, see, small caps rally every 4 years, and that's the cycle small caps rally. They rallied in 2017, they rallied in 2014, 2010, 2007, 2003, 4. So there are, once every 4 years, you have a large small cap surge. Probably, I'm not so sure, but just going by that 4-year cycle, probably 2021 would be the year of small caps. But we have also started investing somewhat in small caps. We've increased our weights in the small cap a little bit, but these are very high quality small cap stocks.
All right, so it's still going to be with quality names that you need to stick by. We'll wait and watch for how growth shapes up, whether 2020 as a year will be any better in terms of earnings too. Amit, let's get your view on IT and what you feel the stocks like Infosys, TCS, HCL Tech for that matter, and even Wipro could do.
Devina, we don't track so much IT services. We are long on we have NASDAQ ETF on for our NRI clients. We also have positions in consumer product companies. The large money would be made in product companies, but in IT services, the only stock we like is TCS, but we don't have it in any of our portfolios. See, in IT, raw material is your employee cost. That's your raw material, and TCS can hire at, let's say, at least 10% cheaper. Like if I am a TCS employee, I'm getting 35,000. For me to, if I get a job at 38,000 in some other company, I won't shift. So TCS has that moat of hiring people at extremely low cost, and that's the reason they have the higher margin. TCS is one bet that we believe, like on all our parameters, TCS comes true, but we don't have any positions here.
Amit, good morning. Do you like any of the listed real estate companies? As much as we might like to shrug them off, real estate has arguably been one of the better performing sectors in 2019, despite the broader markets giving negative returns. Do you like a company bottoms up?
Neeraj, I do like Godrej Properties. See, Neeraj, the entire real estate market in the top 5 cities, Mumbai, Bangalore, Hyderabad, Pune and Delhi. These 5 places, the total real estate sales this year in a bad market was 4.5 lakh crores. Godrej was doing about 5,000 crores of sales. The cost of capital for Godrej this year is 7.9%. For other real estate builders, is somewhere around 24%. This is one area where I can see with some certainty. If you hear Firosha's con call, Godrej is spending 5,000 crores on stamp duty payment. Godrej doesn't buy its own property. Godrej does a joint development model. So Godrej, Firosha was very clear that we are paying 5,000 crores of stamp duty. What does that mean? If you pay 5,000 crores of stamp duty, you're broadly buying 1 lakh crore worth of real estate today. If you see the last 25 projects of Godrej, Neeraj, he sells it before launch. 70% of the projects are sold within 1 week. So he gets a negative cash flows. The other real estate builders are not able to sell even after OC. You need a strong competitive advantage. The unit economics are right. And Godrej doesn't, if you think about it, Godrej even doesn't build the real estate. It's companies, he outsources it to companies like Capacite, Shapunji, Palunji, L&T to make it. So if you think about the real business model, Godrej doesn't buy land. Godrej just pays stamp duty. He just does marketing. He gets customer advances up front, and he doesn't have to construct it. So it's one of the better business models, I would say. He's 1% of the market. If you take the entire top 5 city market, these 1% of the market. I don't believe real estate is a bad business. It's a 100-year-old proven business. It works well. I believe Godrej is one place where I can trust the management, and this guy has the ability to scale for a long, long, long time. But also, Neeraj, one more trend that I'm seeing is in the commercial real estate category. Now, commercial real estate is exactly the opposite of residential real estate. In commercial real estate, if there's a 1,000 crore project, you have to invest because there is no thing as pre-sell in commercial. No one's gonna buy it till the building is not ready. So if there is a 1,000 crore commercial project, you have to invest the entire 1,000 crores and then probably put it on rent or sell it. In commercial space, I can tell you the rents have gone abnormal levels in Hyderabad, Mumbai, because there is no Bangalore, because there is no new construction coming up. A very good model is having commercial rentals on one side and reinvesting that commercial rental in residential side, a model which Oberoi has, but Oberoi doesn't scale up that fast. So that's a problem, and that's why we don't have Oberoi in our portfolio. But real estate is one space that you should really look at, especially the commercial real estate. I believe that's where because you have a buyer at 8%. Blackstone is ready to buy all commercial assets at 8% cap rate. Right. If you can make decent commercial assets, I believe you will do very, very well for the next few years. There is no one who's building commercial assets, Neeraj. No one has balance sheet power.
The supply is also slightly off, but hey, some of the REIT models are starting to do that as well. Embassy Office Parks, for example, is doing precisely that. DLF in their interaction mentioned about how they're going big on commercial real estate as well starting now. So let's wait and watch what happens. But Amit, Jeswani, just one question to that, because your earlier answer mentioned, and both you and Devin echoed this sentiment. What's the rationale? And if you can make it slightly quick, Amit, what's the rationale for somebody to put in fresh money to work in either an HDFC, AMC or a Reliance Nippon Asset Management at these valuations?
See, Neeraj, this is my thesis. I can be completely wrong, but at the end of this bull market, HDFC, AMC, there will be 2 years where your AUMs will grow at 20%. And new people, because the markets will go up 20%, and 20% growth will come from new people joining, because with the bull market everyone joined the rally. There'll be 2 years that I think, I can be very wrong here, where you'll have a 30% plus free cash flow growth in HDFC AMC. At that point, you will have peak margins, peak valuations, peak free cash flows, and everything will peak out at the same time. So that is the only thing which is there. On the downside, see, HDFC AMC is at 1,400 crores of profit. They will make in FY20 1,400 crores of profit, and it's at 66,000 crores of valuation. So it's somewhere around 45 PE. I don't think this one will go anywhere. The downside risk is not so much. At like 10-15% downside risk is the only risk which I see from these levels. But I do expect, if this is a bull market, a proper bull market, there will be at least 2 years, Neeraj, where the markets will go up 20% and AUM will also go up 20% in the equity side. So that'll be the topping part. This is what I see. See, no large crash happens when everyone speaks about a slowdown. The crashes and large drawdowns happen when everyone is full hyper and everyone's in that euphoria mode. I have not seen, there's no history of a stock market crashes with so much slowdown. But the problem is, India is in a slowdown and US markets are in that euphoric mode. So if US markets go down, we will have to go down with them. So that is one thing that I worry, because at one side India is on an extreme slowdown, US is on extreme wave 5 kind of euphoria. So if there is a crash which will happen in the markets, it will not be an Indian crash, it will be a US crash, and that's 100% sure.
All right. Amit, it was a pleasure chatting with you as always. Thank you very much for joining us this morning.
Thank you, Davina. Thank you, Neeraj.